I'm Sumita Karir. Let's go straight to our top story this week, and then, of course, we'll go on to the other stories that we're tracking this hour. Well, after a week-long break, the Chinese market reopened today, but the impact of the bumper stimulus seemed to have faded away as stocks failed to maintain the momentum from September 30th. In fact, the Chinese benchmark index, that is the Shanghai composite, opened the day 10% higher, but pair those gains to end the day with around 4.6% gains. Remember, this move comes after Chinese government's latest stimulus measures that were announced at a news conference. In fact, those stimulus measures fell short of market expectations. Meanwhile, Hong Kong's Hang Seng also tumbled in trade today and ended the day with over 9% of losses. But what's the road then ahead for the economy and the markets, the Chinese markets, and the impact that the Chinese markets and, of course, these stimulus measures will have on the global markets as well? To discuss those and some more points, we're now joined by Geoff Dennis, who's an independent emerging markets commentator. Thank you very much, Geoff. First things first, your first reaction on that briefing that was done by government officials in China. What was the anticipation in terms of a stimulus? And after that, I'd also like to ask you, do you really still feel bullish on China after today's news flow?
I've been skeptical about the rally anyway, so I'm not sure I'm the person to talk about bullishness about China. I've been skeptical because you've seen the monetary policy actions they took several days ago, but we were waiting for the fiscal actions. And I think today's announcement or today's meeting was intensely disappointing because the market was expecting to hear what sort of fiscal actions the government was going to take. And given I think those are necessary to really get this economy moving again and to underpin their 5% growth forecast this year, I think this was there for a perfect reason for investors to take some money off the table and take some profits.
Okay, take some profits, but then what does it really mean for Indian markets? How are they placed? Because, you also have crude inching up on the back of Middle East tensions, and FII still now was selling on account of expensive valuation. Do you see that money moving into India?
Yes, I do at the margin, and I don't think we should necessarily focus too much on the India versus China story only, although I wrote something about this about 10 days ago. I think another point that should be mentioned about China and perhaps why it's not been able to sustain the rally, or at least it's a sign that the rally's cooling off, is because you had a less friendly market environment in the US and globally. You mentioned the oil price. We should also note the big jump in US bond yields back above 4% for 10% yields, 10-year yields, I'm sorry, on the back, of course, primarily of the very strong payroll report in the US last week, which has meant that I think people are pulling back their interest rate cut expectations. So this is a more challenging environment, I think, for global markets now at the margin. Not sure it'll last very long, but it's challenging at the moment. And that also explains in part, I think, why China was unable to sustain this rally as you head into the new week. Now, having said all of that, India had a bounce today. That was good. I'm sure the several-day decline in India did have a lot to do with FIIs pulling out and perhaps moving towards China. But my view remains the same, which is that India is a much, much better bet for investors long-term. Despite high valuations, the growth story is good, and I think will remain good. GDP growth around the 7.5% range. Whereas I think the Chinese authorities have got enormous amounts of work to do to rotate the sources of growth from investment and exports towards consumer spending, which is what you need, and of course to repair the damage in the property market. So I think we're pretty much done with this Chinese rally, unless you get some major fiscal measures over the next few days. I would much prefer to be in India right now.
Okay, so Geoff, you're saying that this rally that we've seen in China over these past few days, that is not sustainable?
I do believe it's not sustainable. I think it could go further in the event, as I say, you get some blockbuster, bazooka, whatever name you want to call it, fiscal measures, which really are aimed at supporting consumer spending and this switch from investment and exports towards consumer. But we haven't seen them yet. And I'm not sure how easy they will be to design in order to get that switch going. And therefore, my concern remains, can China even hit the 5% growth rate target this year? I really doubt it. And so I think we've got a bit carried away in China. The markets in both in renminbi terms and MSCI China in dollar terms are up between 25 and 30% over the last week, even accounting for some weakness in MSCI over the last month, I'm sorry, even notwithstanding some weakness in the MSCI China index today. And I think that's about it. I think we've got to pull back now and wait for the details. Although, of course, there is room for the market to go higher if the Chinese authorities surprise us with the fiscal moves. But it's a show me story now on the fiscal side. So I think we've got to wait for that.
Okay. Okay, Geoff. Now, executives also at the press conference said that there are downward pressures so far as China's economy is concerned. We've seen, the kind of an impact that the real estate sector has had, and those pressures still remain. But do take us through the key risks at this point that the Chinese economy faces.
Well, I think the risks that the Chinese economy faces is still, of course, the property sector, which remains very, very weak. I know with the monetary measures that were taken a few days ago, for example, cutting down payments, minimum down payments on second mortgages, reducing interest rates, etc., are helpful. But the depth of the crisis in the property sector is so huge, if you like, that it's going to take a long time to get this inventory of unsold houses off the books. It's going to take time for people who have bought houses that have not been built to feel they're getting their money's worth, to get those properties or to get their money back. That property sector is going to continue to be a drag. Meanwhile, Chinese investors and Chinese people are very cautious, as you could see from the very high savings ratio. So you need a real jolt to consumer confidence to get the consumer going. So those are the two things you need. You need the property sector to start to improve and hit bottom, which I think we may be several months away from. And we need the consumer to really start to feel better and to spend more. And we're a long way from that as well. So those are the challenges as far as I'm concerned. Meanwhile, what China is trying to do is to export its way through subsidies to flood the global markets with cheap products, which is not going to go down well with the US government. It's not going to go down well with the European governments either. And you can see a lot of trade tensions building up. So there are plenty of reasons to be very skeptical. And my view, quite simply, and I don't model it myself personally, but my view, quite simply, is that getting 5% growth in China this year will be very, very difficult indeed. Whereas I feel the Indian story looks really good. And even though you have to pay a lot for those stocks, I think the long-term outlook for the Indian economy looks so much better than for the Chinese economy right now.
Okay. All right, so you're betting big so far as the India market is concerned, and you're also stating that consumption really needs to be given a push so far as these stimulus measures and policy measures are concerned as far as the China market is concerned. But let me ask you once again, Geoff, now when you speak of the India market, what sort of flows are you factoring in? Where do you see pockets of opportunity versus the China market? What do you project? What kind of growth are you projecting for the stock markets over there? What kind of an impact do you see happening in the near future? Because like I said, we've seen the markets rally in the past few days.
I mean, I don't actually particularly forecast where the Indian market is going, but obviously it's had a very, very good year so far, despite the fact we've seen some sell-offs recently. I think once the FIIs, if they do, cool off on China, which I think they will do before too long, I think some of that money will come back to India. And of course, India itself is being supported or has been supported by significant amounts of resale money as well. Now, my sense is that when you've had something of a sell-off like you've had over the last few days before today, what investors will do is they'll look at some of the sectors and the stocks that have really been beaten up over the last few days and look for some bottom fishing there. But in terms of sectors, and I don't do a lot of work on sectors anymore in individual countries, but if you look at sectors, I think that will look interesting in India. I would be looking at some of the bigger banks. I would be looking at some of the technology names because I think the the pause and the concern over the US technology sector is eventually going to come to an end. And I'd be looking at pharma as well. On the economy, given that the economy is strong in India, and I think will remain fairly strong as far as I'm concerned, the growth numbers will look good. I think certain cyclical domestic stocks will look pretty good as well, so in say the manufacturing sector. So I would be wary about stocks that and sectors that are dependent on the on that price of oil, because as you've just commented, the price of oil has gone up, and who knows where it's going to go in the near term. That will depend very much, I suppose, in the short term on the development of the crisis in the Middle East. But I think oil prices are a great unknown here, and I think companies and sectors that require a lot of oil to drive them, I think, will be ones you have to be a little bit wary about.
All right, Geoff. So you're stating that, of course, some of the sectors that are dependent on oil are the ones that investors should be a little worried about. However, that really depends on how that war in the Middle East really pans out. But overall, you maintain your bullishness as far as the Indian stock markets are concerned. On that note, thank you very much for joining us this evening on ET Now.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.